think there are a couple of things here. First, in agreement, Ken is remarkable, and it's a fantastic book. The dollar is a reserve currency. People hold it because it's a store of value. It's useful in trade and financial markets. It delivers privileges to the U.S., lower borrowing costs, but more importantly, the ability to borrow a lot more. Tom, I do think we want to put this in context. I don't see, and I don't think Ken does based on what he's written, I don't see the dollar losing that status in the next, say, 5 or 10 years, simply because there's no viable alternative. But that doesn't mean the dollar is ever higher and ever stronger. So even a dominant reserve currency can have higher and lower value. And we may be in a period in which the dollar is trending down, not just against the euro, a lot of currencies.
When you were at Columbia, did you work with Hyman Minsky? Was he before you?
Yes, Hyman Minsky was before
He was before you.
Yeah.
You were the young...
Not Mundell. Mundell and I was with Professor Mundell, but not Minsky.
Then, I know this is sacrilege, but how does Richard Clarida link every central bank wants gold into our dollar confidence, and frankly, over to a June 18th meeting? I've never said this. Clarida on gold.
Well, let me say this. I'm following this pretty closely because the purchases in the official data, the purchases of gold are large, and they've been picking up. I'll share an anecdote with you. I was in Asia 10 years ago seeing a very sophisticated official institution investor. And we were talking about gold even then. This is like 2014, 2015, and that was in the context of QE infinity. And I said to him, well, why invest in gold? You can buy an inflation index security. It gives you a hedge against inflation. And he looked at me and he said, gold doesn't default. And so I don't think the U.S. is going to default either. But certainly we have seen that allocation. And again, talk about back to the future. I mean, central banks have been holding gold as a reserve for hundreds of years. And so we're sort of getting back into that mindset.
So, Paul, if gold doesn't default, like a gold wedding ring and a divorce, is that a default? Do you want to comment on that?
No, thank you. Rich, as a professor of economics at Columbia, when you have your class or your module on tariffs, how do you present tariffs to your students?
Great question.
Well, throughout most of my career, which dates back to the 1980s, tariffs have really not been front and center. So I actually typically did not teach on tariffs. I have brushed up on, if I were to teach it, how I would teach it. And what's interesting, if you look at MBER working papers, there have probably been a half dozen working papers in the last 6 months on tariffs, and in the previous 40 years, there were 1 or 2, maybe 0. So it is an interest to picking up. But the short answer is tariffs of the scale and scope that we're talking about now in the U.S. are something we haven't seen in decades, and they have implications for the economy across the board. They generate revenue for the government. They divert some trade into the U.S. They onshore some investment. And so to actually take tariffs at the level that we're seeing now, say 10%, seriously, is a pretty complex modeling exercise with a lot of moving parts. So I'll leave it at that.